Welcome to Furniture Industry News for December 20th, 2024. Today, we're diving into the latest developments in housing, retail trends, and corporate updates that are shaping the furniture industry landscape. The housing market is showing encouraging signs as we close out the year. November saw housing completions rise 9.2% compared to last year, with single-family homes making up about two-thirds of these completions. This increase in finished homes is adding much-needed inventory to the market. In another positive development, existing home sales jumped 6.1% from last November, the biggest year-over-year increase we've seen since mid-2021. The National Association of Realtors reports that sales rose in all four regions of the country, with the West showing particularly strong growth at nearly 15%. Lawrence Yun, NAR's chief economist, points to increased job creation and growing housing inventory as key factors driving this momentum. Perhaps most importantly, consumers appear to be adjusting to mortgage rates between 6% and 7%, which seems to be the new normal for the market. This stabilization in the housing market could signal positive trends for furniture retailers, as more completed homes typically lead to increased furniture purchases. Now, turning to supply chain developments, we're seeing significant changes in container shipping rates that could impact furniture costs. Spot rates have surged dramatically, with the Shanghai to Los Angeles route experiencing a striking 26% increase, pushing costs to $4,499 per 40-foot container. This sharp rise isn't happening in isolation. Industry analysts are pointing to two major factors driving these increases. First, there's growing concern about a potential East Coast port strike in January, leading many companies to front-load their shipments. Second, there's uncertainty surrounding possible tariff changes under the incoming administration. Looking ahead, container analysts expect this upward pressure on rates to continue into early 2025, particularly as we approach the Chinese New Year. This timing could pose challenges for furniture retailers and manufacturers who rely heavily on overseas shipping, potentially affecting inventory levels and pricing strategies in the coming months. The situation becomes even more complex for East and Gulf Coast shipments, with the International Longshoremen's Association potentially initiating a work stoppage on January 15th. Industry experts suggest this disruption could last longer than previous strikes, adding another layer of uncertainty to the supply chain landscape. In retail developments, several major furniture retailers are making strategic moves that reflect evolving market conditions. IKEA's latest data reveals an interesting shift in consumer preferences, with storage solutions dominating their online searches. Their Kallax shelving unit, Billy bookcase, and Pax wardrobe system topped the list, indicating a growing demand for home organization products. This trend aligns with their finding that 40% of consumers feel most content in organized living spaces. RH, formerly Restoration Hardware, is expanding its presence with their first standalone design office in Palm Desert, California. Located in the prestigious El Paseo shopping district, this new location represents part of a broader vision to create a comprehensive design ecosystem in the region. The company plans to follow this with a design gallery opening in 2025 and future hospitality concepts. Meanwhile, significant changes are occurring at other major retailers. Big Lots has announced plans to lay off up to 555 corporate employees in Ohio, including their CEO, as part of their ongoing restructuring efforts. Beyond Incorporated, owner of Bed Bath & Beyond and Overstock.com, has completed the sale of their corporate headquarters to Salt Lake County for $55 million, part of their strategy to reduce debt and fixed costs. Looking forward to 2025, Placer.ai's analysis suggests several key retail trends, including a potential ceiling for discount store growth and changing consumer behaviors around convenience shopping. Their data indicates that while shoppers are making shorter grocery trips, they're willing to travel further for specialty items, suggesting a more nuanced approach to retail convenience. Recent corporate performance reports paint a mixed picture in the furniture industry. Steelcase has shown encouraging results in their third quarter, with revenue reaching nearly $795 million, marking a 2% increase from the previous year. Their success was particularly notable in the American market, where they saw a 5% growth driven by increased business from government, healthcare, and education customers. However, Steelcase faced challenges in their international operations, with sales declining 6% primarily due to decreased demand in Asia, though India remained a bright spot. In response, they've implemented new restructuring actions aimed at generating $5 million in annual cost savings by early 2026. On the retail front, JCPenney's results tell a different story. While their overall sales contracted by 8% to $1.4 billion, they managed to achieve a small operating profit of $2 million, an improvement from last year's $10 million loss. Their home division performed well during the back-to-school season, and their new promotional strategies have shown promise, potentially bringing in over 2 million new customers through their recent marketing campaigns. These contrasting results reflect the ongoing evolution in the furniture and retail landscape, where companies are finding different paths to navigate current market conditions. That's all for today's edition of Furniture Industry News. We hope these updates help you stay informed about the latest developments in our industry. If you found this information valuable, please subscribe to our podcast for daily insights into the furniture market. Until next time, thanks for listening.